As the trading session is currently closed on this Friday evening, July 3, 2026, we are looking at BigBear.ai Holdings under the ticker symbol BBAI, which concluded its most recent session on July 2, 2026, at a closing price of $3.53 per share. This represents a distinct decline of 3.02% from the preceding session, highlighting a persistent downward drift that has caught the attention of algorithmic traders and retail investors alike. While many speculative traders view this small-cap stock as just another volatile vehicle to capture quick swings, the real situation under the hood reveals a massive dynamic shift that the public markets are completely mispricing. A few days ago, on June 27, 2026, BigBear.ai was completely removed from the key Russell indexes, including the Russell 3000E and the Russell Microcap Index. This institutional exit forced passive funds to dump millions of shares, creating an artificial supply shock that explains the recent 24.64% monthly drop, far underperforming the wider software sector. Most retail investors look at a dropping stock price and assume the fundamentals are collapsing, but the reality is that the actual business operations are currently separating from the technical trading pressures. Investors who look at investing sites or rely on self-investing tend to miss how passive index rebalancing creates structural value discrepancies. The expectation across modern online investment forums is that BigBear.ai is a struggling small-cap player destined to be crushed by massive competitors like Palantir. The reality, however, is that management just reaffirmed their full-year revenue guidance between $135 million and $165 million, backed by a sequential backlog expansion to $281.9 million that includes a massive $53 million classified national security contract. When you look at the general retail narrative surrounding individual brokerage selections, whether people use a standard Fidelity brokerage account or execute trades via the Robinhood trading app, the assumption is usually that stock prices move purely on product announcements or retail hype. But right now, the primary force driving this specific equity is the sudden loss of passive institutional support due to index exclusion. When a small-cap technology stock gets dropped from index weightings, exchange-traded funds and mutual funds are legally mandated to liquidate their holdings, regardless of valuation. This mechanical selling volume drove the stock close to its 52-week low of $3.01, completely ignoring the massive expansion in their gross margins, which surged to 34% in the first quarter from 21.3% in the prior year. This sudden boost in profitability efficiency is directly linked to their generative software platform, Ask Sage, which is currently scaling up federal deployment. If you look at standard stock market behavior on an active trading platform like Interactive Brokers Trading, you can see that institutional distribution blocks have dominated the daily tape, while the short interest has crept up as speculative bears attempt to push the equity down. The structural disconnect here is massive. The market is treating the firm as an unprofitable entity facing a liquidity crunch, while the core enterprise is quietly shifting away from low-margin consulting work and moving toward high-margin recurring software revenue within the national security framework. Let us establish some common ground on what the average participant believes when looking for investment help on these types of technology assets. The common consensus is that small-cap software providers cannot survive without continuous equity dilution, and that macro headwinds will cause government procurement cycles to grind to a halt. This belief causes everyday allocators to favor stable megacaps like Nvidia stock or Apple stock, or seek refuge in highly diversified instruments like traditional Fidelity investment products, specialized Fidelity ETFs, or balanced Fidelity mutual funds. It makes sense on the surface because managing single stock risk in a volatile macroeconomic environment requires significant diligence. If you're executing self-investing strategies, it is incredibly easy to get discouraged when looking at a chart that has underperformed the S&P 500 by over 20% in a single month. However, a contrarian approach forces us to challenge the assumption that price weakness equals operational failure. While large institutional vehicles like Schwab Intelligent Portfolios or conservative portfolios managed through Fidelity Wealth Management will naturally avoid microcaps due to volatility filters, independent retail operators utilizing an online investment approach have the unique advantage of agility. They can look directly at the asset backlog and realize that a company valued under $2 billion holding nearly $300 million in committed federal defense backlogs is not a standard failing enterprise. The contrast between market sentiment and fundamental realities is precisely where alpha is generated. To truly understand the recent intraday and weekly movements, we have to look closely at the trading metrics that show up on platforms like the SoFi Trading Platform or Interactive Brokers Platform. Volume spikes have coincided precisely with index deletion dates, confirming that index tracking funds were clearing out inventory. When these large blocks of shares hit the market, it creates an imbalance because there aren't enough passive buy orders to absorb the supply. Concurrently, short sellers noticed this vulnerability and increased their active positioning, hoping to trigger stop-loss orders on retail accounts across the Robinhood stock trading community. This type of technical pressure creates a coiled spring effect. When the mechanical selling concludes, the stock is left in the hands of high-conviction investors, leaving the short sellers highly exposed to any positive contract announcements. We have also seen minor adjustments in forward consensus estimates. While the current near-term quarterly projections sit at a net loss of 5 cents per share, the full-year outlook shows a narrowing loss pattern compared to the prior fiscal cycle. This improvement suggests that the underlying business model is slowly gaining traction, even as the surface-level stock price paints a picture of financial distress. Daily swings have become increasingly tight near the $3.50 level, indicating that the initial wave of institutional liquidation is finding an equilibrium point. At this point in the analysis, let us pivot to what this business actually does and how its operational architecture functions. BigBear.ai operates primarily as a provider of advanced analytics, decision support, and machine learning solutions tailored heavily for the United States national security infrastructure and complex supply chain logistics. The enterprise relies on a business model that integrates predictive software platforms into existing data ecosystems, allowing government agencies to analyze massive data sets for predictive maintenance, threat identification, and border security. Historically, the firm emerged from a legacy of specialized defense contracting and went public via a special-purpose acquisition company, a transition that left it with an initially bloated capital structure and significant non-cash goodwill impairments that dragged down past income statements. In previous fiscal years, such as 2024 and 2025, the organization suffered substantial net losses due to heavy integration expenses and shifts in federal procurement timelines. Older financial reports show a pattern of flat revenues, with annual sales hovering around the $155 million mark, which caused significant frustration for early investors who expected immediate hyper-growth. However, those older periods were characterized by capital-heavy consulting arrangements. The current structure is vastly different, as the acquisition of generative platforms like Ask Sage has allowed them to offer scalable software models that do not require massive headcount expansion to deploy. When checking your portfolio performance on a mobile interface like the Fidelity mobile app or tracking asset movements on a desktop system, you have to look beyond historical net losses to see where the cash flows are going. The historical data shows an enterprise that was burning cash to build a proprietary baseline, but the latest operational updates tell us that their current gross margins are vastly superior to what they achieved 2 years ago. This margin expansion is the fundamental metric that the market is currently ignoring due to the noise of the Russell Index removal. For retail investors looking at options on investing sites, it's important to recognize that the company's core focus areas, national security and trade logistics, are highly insulated from general economic downturns. While enterprise software spending in the commercial sector can drop sharply during a recession, federal defense and homeland security expenditures tend to remain robust or even expand due to geopolitical tensions. This gives the company a level of revenue visibility that many commercial software firms lack, even if government contract allocations are notoriously lumpy and prone to administrative delays. Looking forward, the future outlook for